Welcome to It's No Secret, a podcast for those who want their money questions answered.
Join us as we talk to real Kiwis and share truths about our own financial lives, because the truth is, there is no secret to achieving financial freedom. Lovely listeners, welcome back to another Money Q&A episode to kick off the new year, although we're like 3 weeks into January and it feels like everybody's over the 2025 already. I think just maybe getting back into work and like normal routine has been a trying time, but today we're here to bring you some hopefully positive investment chat joy. We'll be answering some questions that we've received over the break. One in particular that just comes up, actually both of them come up all the time. So felt like it was a timely conversation to just get stuck into these two topics. And with me today, I have a very special co-host, new person on the scene, Joni.
Hi, it's me.
Hi, it's Joni. Johnny's not been on the pod before, but he has been behind the scenes on the pod doing some recording for us. And Joni is a member of the customer success team here at Kernel. So he is here to really hit me with the hard questions that customers have been annoying him and the team with. And I say annoying lightly over the past couple of weeks. So Joni, thanks. Welcome. Join us.
Thank you. It's nice to be here. Kind of weird being a listener right now on those.
Yeah, a listener to a co-host. How does that feel?
Special guest.
Special guest. Exciting.
Front now. So first question, what are distributions and is it different to dividends companies pay?
Great. So distributions, meaty topic. Before I answer that, Joni, do you want to give us a little bit of a highlight of like, how often is this coming up? People, distributions,
every day.
Oh my God, every day. Okay.
Every day and closer to when I guess the fund does pay the distribution.
Sure.
Everyone's kind of curious, like what does that mean?
Yeah.
What am I getting?
Cool. Yeah. So Kernel customers, I think that have been investing with us for a while, you probably have picked up, like they're in the behavior of understanding that most of our funds pay distributions quarterly. Mm-hmm. And so, yeah, you're right. They do kind of tend to monitor that distribution payment is coming through for better or worse. And we'll talk about maybe some of the reasons why they shouldn't be monitoring it so much. And then of course they ask around, what is the distribution? How much is it? All that kind of stuff. And what do I do with it? So back to your original question, when we talk about distributions versus dividends, they are different in the sense that they are typically two different types of payments from different structures. So what I mean by that is we'll all be pretty familiar with the fact that a company that is I was going to say a listed company, but any company that's profitable and has retained profits has the option to pay out a dividend to its shareholders. Now, investors will be familiar with the fact that this is a relatively common placing to happen with, strongly profitable companies that have a really great balance sheet and like positive cash flow and are very stable, will be known as kind of, consistent dividend payers. Mm-hmm. And shareholders in that listed company would expect to receive a dividend usually twice annually. So there would be one kind of primary dividend payment, and then there's usually what's called an interim dividend payment, which is 6 months after the primary to kind of pay out interim earnings as the year tracks on. So a lot of investors that have been investing in shares or have friends or family, my parents, thinking about them, like they were all into the stock market, not so across investing in funds. They tracked things like the dividend payments that were paid out of like their Commonwealth Bank holdings in Australia or Telstra, because they were institutions that were very profitable, kind of very secure, known dividend payers. And the ethos was really around like, you want to get that dividend paid out to you to then either use that for income or reinvest it into the share market. So that's a dividend. When we talk about a dividend, you can basically think about a distribution in a similar type of concept, except for the fact that a distribution is coming from a fund, right? And at its essence, the fund is a collective investment of lots of different companies. So what we're basically doing when a fund pays out a distribution is it's taking the collective dividends or earnings that have been paid out from the underlying companies back to the fund to then on pay to the unit holders in the fund. And the fund is then electing to pay some of that out as a distribution. Yeah. So not all funds pay distributions. There might be some funds that, like not all companies pay dividends, right? There are your high growth tech companies that aren't paying dividends because they are reinvesting any money that they do have back into the company, or perhaps they're not profitable, but they are listed. So, not every company pays a dividend. Similarly, not every fund would pay a distribution. And the distributions that are paid out of a fund will vary in the same way that a dividend will vary, because companies' earnings are variable. Does that make sense?
Yes.
Yeah.
Yes. I guess another question to follow up on that
Yeah.
is, so our funds pay it quarterly, as you'd mentioned.
Yep.
Is there a chance like a certain company in the fund may not pay a distribution, and would that impact the whole portfolio of the fund? Because from what it sounds, what you're saying, it's like a nice to have. So it's not guaranteed, but because a fund holds multiple companies,
Yep.
does that reduce the risk of not receiving like a distribution?
Great question. So, it's definitely a nice to have. And I love the fact that you mentioned that it's not guaranteed, because people could think of like distributions or dividends not being guaranteed in the same way that a positive return from that company or that fund over a year is not guaranteed, right? There's going to be market movements. And the reason that one of the reasons that there are market movements is because a company will have varying performance. So an example that we can obviously give is like in New Zealand was, prior to COVID, known as a relatively strong company with somewhat stable dividend payments. And then, of course, during the COVID time, they went through a whole financial challenge and didn't pay any dividends for a period of time, and then reverted back to that once they were in a more stable position. So, a company paying out a dividend is absolutely not guaranteed. And so as say like a Kernel fund, we don't know what the underlying companies are going to do in terms of performance or dividends. The reason that we pay out distributions quarterly as opposed to annually or twice a year is because we want to pay out that capital with some frequency, and also all of those underlying companies will pay their dividends at different times, right? It's not like there's a mandated time where every company around the globe must pay their dividend in March. They do have some choices to when they pay that. So the quarterly frequency definitely allows for more of that cash flow to go to investors that require it in, say, a cash distribution.
I see.
Yeah.
Okay.
But yeah, definitely not guaranteed. And I think that's why you would expect to see variability as an investor in the distributions that you hold, even from year to year, whether it's quarter to quarter or year to year, right? In the same way that you'll see the returns fluctuate on the fund.
Yes, that's right. Cool. That's good to know.
Yeah.
When are the distributions paid out to Kernel? You mentioned quarterly. Is this like a fixed date or month every year? And is that the same for all the funds?
Yeah, great question. So it's generally the same now for all of our funds. Again, this is at the discretion of the fund provider and kind of per the documentation, the product disclosure statement and the SIPO and the OMI that sets kind of like the distribution policy alongside the investment committee. But we have always maintained quarterly distributions for all of our funds that do pay distributions. We have recently moved to having more of a fixed rather than a floating date on that. Mostly to do with the fact that most of our funds or all of our funds are now at like significant scale. So it was better for us as a fund manager to have a bit more flexibility around what exact date in a month we could pay a distribution when the funds were smaller. Because as you say, one company that, say, is a very strong dividend payer might be very beneficial to kind of wait until that dividend has come through before we then pay out distributions to investors. Whereas when the fund is more at scale, those types of impacts are a little less so. So we've now moved to paying them on the 15th of the month for the quarter prior. That's hard for people to wrap their head around. But that, I guess, a practical example of that is if you think about a quarter ends in December, the December quarter would be paid in January, in the middle of January.
I see.
Yeah.
Okay.
Yeah.
Interesting.
Yeah. Okay. Joni, you're an investor at Kernel. So what's your distribution choice?
My secret's out there. So I have it as, so originally I've had it as reinvested and I've had it as cash.
Okay, talk to me about this logic.
So for me, I had a change in circumstances at one point. So originally started Kernel, found them in the black hole during COVID.
Yeah.
Started with reinvest because at the time I was somewhat of a beginner investor, but one of the reasons I went with Kernel was because at the time they were one of the few providers that provided the option to reinvest. So
Automatically without you needing to do anything.
That's right.
Yeah.
Yes. And I think also at the time they also had the funds that I liked as well. So I considered going through like other providers, not going to say names, but I just found it as an unnecessary.
You're so PC. This podcast is definitely more out there, Joni, but I love it. Bring your true self.
No, I just didn't want the extra step of having to log in and click, because I also didn't trust myself in the sense of having discipline. Like, maybe I'll just take like a little bit out.
Yeah,
You
don't need to look.
Exactly.
If they're being reinvested on your behalf, it's like you don't actually need to really log in.
Yes,
you could kind of just let it go for 6 months or 12 months.
That's right. That's right. So I had it originally as reinvested.
Yeah.
Went for like a couple, 2-3 years. And then I had a change of scenario in my life. I went back to school.
Yeah.
And at the time I sold a good chunk of the investments, and I also had it paid out as cash to help cover some expenses here and there. School was only about like 6-9 months.
Yeah. Just quick side note. I know this is not a Joni Money Moments episode, but I would like to say, Joni, that is an amazing example of exactly what we talk about in terms of like your portfolio should change when your circumstances change, not in relation to you changing them because of market movements or Trump getting elected or something else happening outside of your control.
For the record, I didn't buy or sell just because.
Yeah.
It was just a slight tweak.
Yeah, because, you had a different like path that you headed down that obviously affected, I'm assuming, your income because you were studying and other things, and you need a bit more flexibility. And that's a perfect example of a time where you should absolutely look at your portfolio and think, okay, should I maybe tweak something here to just better position me where I am now?
Yes. This is a personal opinion, but I would say that I wouldn't suggest having it paid out as cash unless you absolutely need to. So in my case, I did go back to school, and I had a big drop in income because I was working part-time, which is why I opted to have it paid out as cash. But even then, if you look at the realm of things, getting a payout every 3 months, unless you have a very sizable portfolio, is not really that much. And when you do get that money, even though you say you will use it for bills, there's a very high chance, given you're making a lot less, you might just use it for what you want, which is actually what ended up happening with me. So
well, you're probably like, oh wow, there's like a couple $100.
Yeah, I was like,
this is great.
Nice.
I might just like go out for lunch.
I deserve
this
it,
weekend.
I mean, I did.
Yeah.
But just
Yeah. That's a very fair point. Yes. And you make a valid point about I think, people often think that a distribution or a dividend, if they're investing in individual companies, is the way to fund their income needs from investments, and do overlook the fact that if you want to solely rely on the income being paid out from an underlying company or a fund to fund your income needs, you need a seriously sizable portfolio to do that. Yeah. And whilst that is possible for some people, that's probably not the achievable norm for most. What the more achievable behavior is get your portfolio to a size, and then over time, as you need it, make redemptions out of that portfolio that include the contributions that you put in, your earnings, and the distributions paid over time, and actually make withdrawals to help fund whatever income need you have.
That's right. That's absolutely right.
I feel like people just don't, it's a harder thing because you kind of feel like you're going backwards because your portfolio would start going backwards. But the fallacy of kind of thinking like, oh, I could, have a couple of $100,000 invested and then just live off the distributions, like the math ain't mathin'.
The math ain't mathin'. No. And realistically, look, there's multiple angles. Like, as you said, you don't need to solely rely on one stream, right? Yeah. It's like how, I guess I don't know, this is like, I don't really know how to say this, but nowadays everyone's like, oh, you need like a side hustle, you need like 2 incomes, like you don't necessarily need just one source to make everything work. And definitely. You can, adapt it just like your portfolio as well.
Exactly. Well, and I think that's why there's also a great point, because one source of income into your portfolio is the dividends that are paid by the companies. The other source of like earnings in your portfolio is the growth of the share price, which is your capital gain. And if you want to benefit from the growth of that share price in terms of you being able to actually use that to fund your lifestyle, that requires you to redeem the funds. And that's okay. That's the point of like accumulation, is to then
slow and steady.
Yeah, exactly.
Awesome. Since we're
so are you back on reinvest?
I'm back on
now
reinvest.
That your situation has changed?
Yep. And my portfolio too.
Okay, well that's
we won't get into that. We won't get into that.
Yeah, okay.
Since we're on the topic of having, reinvest or cash,
yep.
and I think some people everyone has like their own way, but going on a tangent off that topic, I guess. Okay, we can have it. We have the option of having the reinvest. And for people who don't or aren't really sure what reinvest means, could you quickly explain what exactly that means?
Yeah, great point. So basically what the reinvest option is when the distributions are paid out of the fund to the end unit holders or like the investors in the fund. If it's cash, they get that money literally paid to them in cash. And if they select reinvest rather than paying that money to them in cash, we buy them more units in the fund. So they get issued more units in the fund. So they're basically just converting the cash dollars to more units. So to your early like personal example, it is one of the easiest ways to just be reinvesting the income from the fund without you needing to think about it, without you needing to log into your account and manually place any orders, without you needing to, assess what's there or remember the fact that it's the 15th of like, what month is it? Is it January? Is it March? Like, I don't know. If you have it on reinvest, that's just going to happen automatically for you. Yeah.
Second question. So we have multiple funds at Kernel. Let's say I'm invested in 3 or 4. Can I have like 2 paid out as cash, 2 reinvested?
Fantastic question, because I know you get this all the time.
Yes, I do. Just
so
putting it out there.
This has a little bit of technical nuance to how unit holdings for unlisted funds are managed in what's called a registry. And without getting into the full detail of that, the short answer to your question, Joni, is no, because it needs to be set at the portfolio level. So what that basically means is how you're treated as a unit holder and your unit holder election is reinvest. So that basically then means you are in the reinvest units for, say, the Global 100 and the NZ20. If I was in cash, I would be in the cash unit as a cash unit holder for Global 100 and NZ20. We don't have the functionality between us or our registry provider to basically facilitate an individual fund by fund choice. I would also probably say, because I can understand why people perhaps think about that, but I'm also a little bit like, what are you trying to achieve? Why is it necessary? To your point about like, why do you want cash paid out of one fund, but maybe other funds reinvested? What are you using the cash for that's being paid out? Is there a way in which you can get cash out of your portfolio that's just a bit simpler? And maybe on a more flexible time frame. Like that's the other thing I think people sometimes overlook is the beauty of it being invested in unlisted funds like Kernel and some other funds is that there's no transaction fee for you to sell. So if you needed to get cash out of your portfolio and that's why you're looking at getting cash dividends, cash distributions, right now you only have the option of having those quarterly. But what if you need to have income out of your portfolio every month? There's a much easier way to do that, which is just to have, a sell order processed every month and then have that money paid out to you. So I would probably go back to that customer and say, hey, hear your question, simple answer no, but also like, what are we trying to achieve here? Are we overcomplicating things for the sake of it? And is there another way in which we could achieve what your intended outcome is?
That's a very great explanation. So takeaway from that is just keep it simple. And it's not one solution that fits all.
Yeah. And think about your income needs.
Yes. Think about income. It can change as well,
There are other ways in which you can fund, income needs from a portfolio. And I think we need to normalize sells, normalize redemptions. That's A-okay.
Yes. Yeah. Going off that, just a small fun fact. So when distributions are paid out, they're paid out to your Kernel account, not directly to your bank account.
Yeah.
One of the reasons for that is because some customers may deposit with multiple bank accounts and we'll have multiple bank accounts on file. We can't necessarily choose for you. So to simplify it, it's paid out to your wallet.
Yep.
And from there, you can withdraw to whatever bank account you have on file.
Exactly.
One last thing on distributions and distributions from the funds at Kernel. Without getting too complex, I guess, am I disadvantaging myself or is it more advantageous to have it reinvested or paid out as cash? Like essentially, am I losing
Is there a
one
better
or the
option?
other? Yeah. Am I losing one or the other?
I'm so glad you asked this question. So no. The shortest answer is there is no financial difference to you as the end investor by having either the reinvest option or the cash option. The other thing I will say, because we also get this question, is there is no financial difference to you as the end investor to selling all of your funds from a Kernel fund 3 days before the distribution payment is made versus selling all of your funds 3 days after the distribution payment is made. Part of the reason why I think this is confuses people is this is different to potentially how dividends work with companies. Yeah, so people that have bought listed companies will know that when a dividend is declared, there is basically I'm going to lose the terms off the top of my head, but there's an X date and there's a date in which you have to be a shareholder in the company to be eligible for that dividend. And then if you're a shareholder at that point in time, you get paid the dividend. Yeah. How it works with a distribution is all those dividends are being paid from the company back to, let's use like Global 100. So let's say, 20 companies within Global 100 pay dividends out at a period of time. All that money goes back to the fund and it would get paid to the fund in cash. Now, as an index fund provider, it's really important to us that we have basically no cash or the smallest amount of cash in the fund at any one time, because in an index, there's no cash. And our job is to deliver you the index performance. So when we receive the dividends from those 20 companies, we reinvest that straight into the fund. Yeah. So that's what our portfolio managers are doing. That's what our investment operations team is doing. On the weekly basis, as dividends are coming through from the underlying companies, they are reinvesting those dividends back into the fund in proportion with how the fund should be invested for the index weights. And so if you think about it, the company has paid out earnings. Those earnings have already been reinvested back into the fund that you own. So you haven't lost any value because those earnings are back into the fund, which means the unit prices are more valuable, all that kind of thing. So that is reflected in your account. And then at some point in time where we either have enough cash at a moment close to the quarter to pay distributions, we pay it and we use any cash available. And we sometimes also use do a capital redemption, because what we've done prior to that moment is reinvest those dividends, right? So we do a capital redemption from the fund to pay out to people and use any cash available in the fund to pay out distributions. Now, if you receive that in cash, you still have your units and you get your cash. If you get it in distribution, you have your units and you get more units. But the sum of those two and the sum of these two equal the same.
I see.
Yeah, so you're not disadvantaged either way. It's just how you're receiving those earnings, basically. Are you receiving them as more units in the fund, or are you receiving them as cash? And to your point about which one is right or wrong, I guess, one thing that we kind of were talking about before we started recording was we often see people that have distributions paid out as cash, and then in the following week they go and reinvest that money in the same funds anyway, which is possibly speaking to investor behavior and just the psychology of investing, and perhaps people wanting to have control, which I totally get, or maybe just not understanding how distributions work if you are on reinvest. But yeah, because distributions are treated differently to a company dividend and they're constantly in the fund, the point at which you sell a fund, whether it be 3 days before the distribution date or 3 days after, is irrelevant, because all of that money is already within the fund. It's already reflected within the unit price. You're not being disadvantaged.
Okay. It's good to know.
Does that make sense?
Yes, it does.
Yeah.
I also learned something new today.
Yeah. I guess the different example, right, to say a dividend for a company is, let's say a company declares a dividend and then they have, I think it's called the X date, which is the date in which you have to be a shareholder. Now, if you have a dividend being declared and the share price is whatever it is, usually what will happen is the share price will adjust at the date at which a dividend is declared, because the market will be reacting to whatever that dividend is, and obviously the company's earnings announcement or whatever kind of associated financial information they've released at that point in time. Now, if you then decided to sell your shares before the X date, you won't get the dividend because you're not a shareholder after that point in time. So that's why it can be different. And so, and I guess as well, that's because the company hasn't yet paid it out and the share price is not the same as the company's balance sheet.
Yes.
Whereas what you can think about with a fund is the unit price of a fund is basically the fund's balance sheet. And the fund's balance sheet is owning a small portion of cash and a lot of portion of companies, and constantly reinvesting that cash. And all of that collective is the total of the unit price.
I see.
Does that make sense?
Yes, it does.
Yeah?
It does.
Yeah. So I think that's why, like, you know, we do have those questions from people that probably have a lot of experience of investing in direct companies and just are assuming that a distribution payment is a similar type of thing.
Similar but different.
Similar but different. Yeah. I can empathize with people that get confused because there are similarities, but then there's also just like functional differences.
I guess I see where you're coming from, maybe because I work on it in a daily basis.
Yes.
But when I was new, it did take me a while to wrap my head around it as well.
Why is this so complicated?
Yes. Yeah. The technicalities behind it are pretty similar.
Yes.
But just trying to wrap your head around the idea when it actually happens.
Yeah.
It's easy to forget things.
Yeah.
But yes, thank you for explaining that.
That's okay.
Cool.
Nice. What is the other burning customer question of the day?
Okay. Should I have a few investments held across different platforms. Is it worth keeping them across different providers, or should I just move everything into one platform? We get this across a range of customer ranges. It's not just
Talk to me, Joni, about what's your personal view / your professional view? What would you tell someone?
Professional. Okay. So
I mean, we obviously can't give people advice. So
not financial advice.
This is one of these ones where it's like we can't tell you what to do. Okay. But what are some of the points that you would raise to them?
Okay. So I guess for starting out, this, to be fair, this goes again, like I said, across all customer segments. So whether you're new investing, professional, young or old, it's the same. So let's go between pros and cons, right?
Yep.
So pros, I can have everything in one place. To check into one account. Very easy to understand one fee. Everything's in one place.
Yep.
If I get distributions, reports, everything's in one place to go. It might also have like exclusive features from platforms. So as Kat had mentioned earlier, being reinvested into a fund. Nowadays it's more common, but we reversed.
Also, if you have more money with one provider, you might get different benefits than having smaller amounts of money with lots of different providers.
That's right.
Because also I was thinking, I was like, you've potentially, I mean, I'm not saying that this is actually what we do at Kernel, but my mind went to, well, if I've got more money with one company, whether it's like, let's say it's a bank and your mortgage, it's like you're hoping that you have a little bit more sway or you're a more valuable customer to them and therefore like your service will be great and all those kinds of things. Whereas if you're like a bitsy company to a client to lots of different companies, just the fact of reality is like you got a little less pulling power.
Cons now.
Yes.
We wrote this down prior to it.
Okay.
And I don't know why we came up with more cons, but maybe it's just too early in the day. More tempting to take out. So I have things all over the place. I can just take my money on one thinking I'll have a lot in others. It could be more difficult to check on all the balances, you know?
Definitely. Of having in different places.
Yeah. Like you could have like 4 different accounts with 4 different passwords with 4 different like emails because some providers will acquire you.
I also think the tempting to take out thing is a really, really valid point that we've probably not talked about before, where you definitely have a different mindset to a balance of $10,000 comparative to a balance of $40,000.
Yes.
And let's say you have 4 different providers and you've got 10 grand with each of them. I guarantee that your mental hurdles that you need to go through to make a change or withdraw money on one of those $10,000 accounts versus like if it was all consolidated and it was a $40,000 investment account would be different.
Yep. Yeah. Definitely. So yes, definitely agree with you on that. I'm hopping all over the place here, but essentially what I found looking at my peers is they will generally start with one platform, kind of like dip their toes in. And depending on like what social media platform they use or who tells them about it next, they might hop to another one because it's a new shiny object, right? Now, sometimes that can be like a pro and con because you could find things with a new provider that you could not with the previous one. So case in point, at Kernel right now, we only offer funds, managed
Yeah.
funds. We also have like, online save account. But for example, if you went to Sharesies, they have individual shares, they have funds. There was Hatch at 1.2, which was the only provider that provided like US only shares.
Yeah.
And there's obviously like other platforms do like crypto and all that kind of stuff too. So it's very hard to find one provider that does everything well.
Yeah.
They may provide everything, but they may specialize in one. And
You might need to make compromises, right?
Yeah,
like
yeah,
you might
exactly.
get your ideal KiwiSaver solution, but maybe not your
That's
ideal
right.
like fund solution.
Yep.
And then you kind of have to make the choice of like, well, do I want to keep these separately and have, the overhead of managing multiple things? Or am I okay with like a little bit of trade-off?
Yes, that's right. And also another con of that is like each provider may have a different fee structure as well, depending on how they set up.
I guarantee you they will.
Yeah. Very similar. It's again, similar but different.
Yeah.
Varies. I can give like an example as well. So a family member of mine, when we came to New Zealand and stuff, I helped them get set up and everything. At the time, Kernel didn't have KiwiSaver. So we went with another provider, very, very similar, very great products as well. KiwiSaver set up there. And they started investing outside of KiwiSaver through us. Now, eventually we launched KiwiSaver. And I told them like, oh, just move it over here. It'll be easy.
Yeah.
For whatever reason, they said like, no, it's okay. We have it there. And
Yeah.
we just prefer to keep it there and we'll have it here.
Yeah.
Right. Even though it was pretty similar, instead of consolidating it. Now that could be for a variety of reasons, right? It could be because they want things separate so they don't check on the balances, which is great. It could be because they think, and I think we need to bust this myth real quick, that having your money in multiple places
Means it's safer.
yeah, means it's safer. We'll all report to the same people. They all check the same accounts.
We're all regulated by the same authority.
Same authority. It's like
we all have the same license.
all the same license. Like you put money in ASB or Westpac, it's the same thing.
Yeah.
Right?
Yeah.
Different colors.
Yeah. It is kind of funny that people do that more with, say, KiwiSaver and investments or investments, but they don't do it with banks.
Yes.
Like, I don't know anybody that's actively being like, I've got half of my bills deducted out of Westpac and I've got half of my bills deducted out of ASB because I just want to make sure that my money is safe. Like, that's just a nightmare.
Maybe when we get bigger, we'll get that privilege too.
Yeah. Yeah,
But-
this is true.
Yeah, for the record, just putting it out for everyone out there, all the providers of managed funds or shares are all regulated by the FMA, Financial Markets Authority. So we all have to have the same processes in place. So, it's arguable if you still don't believe us, you can check their website.
Yes.
But essentially, we all have to follow the same rules. So having your money with provider A and sub-provider B, there's no really difference to it.
Yep.
If that's your main reason,
Yes.
maybe just have a check again. But if obviously there's other reasons too, where you just don't want to check the balances, you're not tempted.
Yeah.
It's not a great idea,
Yeah.
Yeah.
Yeah. And I think as well on that, like one of the extensions of that argument that people often put forward, Joni, is like if they're a couple, they'll say, okay, well, my KiwiSaver is with Kernel, so I don't want my husband's KiwiSaver with Kernel. Because what if something happens to Kernel, which we just talked about, but also if his investments are doing well, my investments might do bad. And so I don't want like us both to have a bad year at the same time. If you're both investing in high growth funds in two different providers, the chances of you holding the same or very similar allocations to the underlying companies is so high that, you're like, that also just doesn't really feel like a logical argument. But as we know, people don't make investment decisions out of logic often. It's emotional, and it's I think also people trying to put into a situation where they're accepting the fact that they're not an expert because they don't need to be, but they also want to have some element of control. And if their way of expressing an element of control is by saying, I'm making a choice that my KiwiSaver and my investment will be different, and that my husband's KiwiSaver and my KiwiSaver will be different because that's how I exert my control and that's how I can sleep better at night. That's cool, but also like maybe don't.
Yep. It's personal finance.
yeah.
First word personal, then finance.
Exactly.
So-
Exactly.
My personal opinion, having said the professional opinion,
Yep.
is that it's okay to have multiple platforms, but I guess you should always go back to the why,
Yes.
right? So you might start with 2, you end up with 5. That might be a bit overwhelming. Or you might not even end up with using multiple. You might just use one, right?
Yeah.
But if you are going to use multiple providers, it's more asking yourself like, okay, remember what the long-term goal is? Everyone's long-term goal is different, right? Depending on your age goals as well. And also your strategy is how to get there. Now, everybody can give suggestions, but at the end of the day, it's up to you. So I may have like, satellite portfolio. I might have bulk of my investments in like managed funds with provider A,
Mm-hmm.
and I want to do a little bit of, shares and maybe other assets, which I can't name, outside, elsewhere, and that's perfectly fine.
Yeah.
Because you can't get everything in one place. And even if that means you have multiple fees and stuff, that's fine.
Mm-hmm.
Again, like Kat said, if your way of exerting some comfort or control is having things in multiple places, that's fine as well.
Yeah.
It's just good to have an idea of where things are.
Yes.
Because like a bank, you can, you might have your money in one bank and you have a mortgage in another bank, but you're not going to forget where you had that, right?
Yeah.
And I think it should be the
Absolutely.
same with like investments as well.
Yeah.
You don't need to check on it, but it's just to have an idea. And along the way, if, plans change, you can always leave and come back again,
Yeah. If you start with 2 and you end up with 5 and you're like, I want to go back to 2, you can do that. That's fine. It's not like you're getting married to the investment platform. You can.
Oh, we would love to have you here.
I mean, we're here for a 40-year commitment. It's fine.
40-year commitment.
We are,
We're
but
here.
you don't need to be. It's okay.
Yeah, if you leave us, you don't have to close your account.
Yeah.
Just leave it open. Come back whenever you want.
Exactly. So how many accounts do you have, Joni, now that you actively manage? Like that you're logging into, say, like once a month?
I was asked this on my interview when I applied to work here. To be honest, I opened accounts with almost everybody I can think of.
Okay.
But I don't use anybody else now.
Okay.
Okay.
So you're primarily managing through one investment option.
Yes, that's right. This is a very holistic
Yeah.
view.
Yeah.
So I'll just label the names out there so everyone can
Tell
scream
us.
at me on Reddit.
Tell us.
I started with Simplicity, and then I opened a Kernel account. No, Simplicity. Yeah, Simplicity, and then I think it was Kernel or Sharesies, and then Kernel. I had a Hatch account at one point. Tried Stake when they were first blowing up. Have an Easy Crypto account. Don't have any crypto. Don't hate on me. Have money with I think 3 banks at one point.
Okay.
I had accounts with 3 just for different reasons. Squirrel money as well. Online pretty great as well. Must say with everybody that I signed up with, they made the process super easy except BNZ. I don't know why. Will, if you're there.
Shout out to them being shitty.
Will, if you're still there, help me out. They don't believe me.
Oh my God, that's hilarious.
But yeah, open accounts
Like,
with pretty
what is
much
this?
everyone just to get a feel, because you don't like, and maybe because I am like a personal finance geek, right? I went down that rabbit hole
fair.
during COVID. So
Yeah.
it's just liking to see. Whereas my partner is the complete opposite. She just likes to have everything in one place, hates having to like call, click, read something new. And that's perfectly okay.
Yeah. I'm a bit like that. I have everything in Kernel. So I only have one investment in KiwiSaver provider in New Zealand, which is now Kernel. And prior to that, I only had Simplicity.
Wow.
My Hatch and Sharesies account got closed from inaction. Yeah, like they closed it on me, which I'm fine
Really?
about. Yeah, I was like, cool, I don't want it anyway. Thanks.
I haven't closed mine.
Thanks, bye. So those have gone. And I have an ASB account and a Westpac account. And then I am so motivated by, I like control, which is oversight. And so I don't like having multiple things to log into and passwords to remember. And the one bugbear I have about this is that I do have my superannuation in Australia still with Macquarie, which needs to stay there. So to your point about like you have to think about the why, I'm like that needs to stay there because I can access it earlier and I like how it's invested, but it really annoys me that I can't see it like easily. And so I have had the thought cross my mind of like maybe I should transfer it over, and then I have to be like, no, Kat, that's a dumb idea. What are you thinking about? Duh, stop it. So yes, I am motivated by like the simplicity and the control element as opposed to the like FOMO element of I could have this other thing. I want to have a look. I'm just like, it's too hard basket for me.
FOMO is real, guys. Even for us, FOMO is real.
Yeah.
With what you said as well regarding multiple platforms, I did try a bit of everything too.
Okay.
So for me, it was like early stage, I didn't know what I was doing. I still kind of don't know what I'm doing, to be honest. But it was just a little trying here and there and finding out more about yourself and also what you like.
Yeah.
And, at the time, it made sense maybe to use like those other providers. And at a certain point, I was like, you know what? I'm just going to consolidate, keep it simple. And that's what worked for me.
Nice.
So there's no right or wrong. Personal finance is personal.
Love it. Yeah.
But if you're maybe forgetting where things are, if it's time to like do your MyRD report and you have columns or rows that you don't know what this
like,
means.
what is this?
Like you have no idea, then maybe it's time to downsize a bit,
Fair.
Yeah.
Fair. As someone that's approaching their later 30s, I'm like, the speed in which I am starting to forget information about my own life is terrifying. So, Joni, I would just say, as someone that's in his 20s, maybe just plan to be consolidated by 35. Hot tip. Free recommendation from this
Okay,
potty.
let me write that down real quick. Hold on a second.
You really just want to remove your life admin to like the bare minimum by age 35.
Keep it simple.
It's too much after that point. It just can't. So yes. Well, this has been a really fun chat. I love these questions. I also feel like they're evergreen because distributions and dividends are going to be here forever. You know, there will be more platforms popping up, more different options. More platforms will offer more services. Like the competitive landscape is getting better all the time, which is a really good thing because it does provide people with more options. And sometimes that does mean that maybe you should make a change. But equally, it's like, finding that place for yourself that is not too overwhelming, but also provides the right type of investment or service that you actually want to use.
Yes, that's right. The why.
Yeah. The why and the personal.
The why and personal, yes.
Great.
That's the secret of It's No Secret.
So there is a secret to this podcast. Okay, great. Well, thanks for listening today, everybody, and joining us in this chat. Big thanks to Kernel for enabling us to do what we do and for letting us borrow Joni today to get all his great insights from the customer success team. Don't forget to hit like and subscribe wherever you're tuning in, whether that's video on YouTube or listening on Spotify or Apple Podcasts. If you have any questions, it's a new year, possibly a new you, feel free to get in touch at It's No Secret NZ on Instagram. Send us any episode requests, questions you want us to cover on a Q&A or just a topic coming up. We've got lots of fun things that we'd love to dig deep on, so let us know and we will chat to you next week. Bye.